Joining us on the program is Jeff Clark. He comes to us with Casey's Gold and Resource Report. And Jeff, let's talk about the price of gold, and let's begin with the gold stocks. One thing that we saw in 2007 and 2008 is even though the price of bullion was rising, the gold stocks were not going up as much. Was that really a reflection of what was going on with margins with gold producers, because we saw rising energy prices, labor prices, steel prices? Let's begin with that and contrast that to the market or margins for gold companies today.
Sure. Basically, the average gold price in 2007 was, for the entire year, was $695. And then on top of that, you had, as you state, costs were going astronomically higher. Oil and energy costs, I guess I should say, comprise, at least a third of the costs associated with mining. So when a third of your costs are doubling within a year, which is what oil essentially did, that's going to kill your margins. And so the margins for most gold producers were not attractive. That kept the valuation low and did not make the companies as attractive. Contrast that with the average gold price in 2008, which was $871, and then in 2009, now just to date, the average gold price is $935. So what you have is the price of the product that you're selling is 34.5% higher than it was 2 years ago. And so far it's 7% higher than just what it was 9 months ago, last year. And so with costs relatively not rising now, they're relatively fixed, it's easy to see how profit margins can be a lot higher for most companies. I mean, it would be suddenly if Microsoft was able to sell a $1,000 laptop for $1,500. That's essentially what's happening to the mining industry. Their profit margins would soar. So,
something else that has changed in this bull market compared to, let's say, the 70s, you've had companies are having greater difficulty replacing the reserves, and South African producers have seen declining production. In other words, the South African mining companies don't dominate. They're still huge in terms of production, but, there's China now has become the largest producer of gold in the world. I wonder if you might contrast some of the dynamics that are at work here as opposed to, let's say, the past bull market of the 70s.
That's a good point. In the 70s, the gold bull market was centered around South Africa. They were the largest producer of gold by far. Margins were real high, and they were paying just incredible dividends. I wasn't investing at that time, but Doug Casey, who I work for, told me that some of these companies were paying 50% dividends. So there was incredible profit margins there and an ability to profit. Since then, we all know what's happened. South Africa production, as most countries, is down. China is one of the few that's rising, and they are, in fact, the largest gold-producing country in the world right now. Peru has been rising a little bit, and Canada's kind of flat, but all the other top producing nations, if you look at the list of the top 10, they're all losing production, and China is going up now. There's some catches to investing in China, though. There is risk there. They are not as transparent as other companies, and you need to have companies that have good contacts in the country that are well experienced, because otherwise you could run some risk there. And there aren't as many public companies investing or exploring for gold in China. But they're clearly leading the world at this point. That's number one on the production side. On the retail side, it's widely expected that the demand for gold there will pass that of India. So in other words, they'll be the world's number one retail buyer of gold as well. And then, of course, we all know the Chinese government has been buying a lot of gold. A lot of it's been on the fly, but they have been buying a lot of gold. So China is where a lot of opportunity lies in terms of not only what will happen to the gold price, but where some profit opportunities for investors will be.
Well, another thing, too, would you say is different this time around? If you looked at the 70s gold bull market, you had a lot of companies that had a single mine focus, and I think with political risk, today you see even the intermediate producers. You take a company like Agnico Eagle that had one mine. Now they're bringing 4 new mines into production. So the geographic diversity that you see with mining companies today, it's more than just one deposit. It's several deposits, and it's located in several different regions of the globe.
That's true, and that's actually a smart thing to do to diversify your risk. There is no perfect country out there in terms of gold mining. Some are obviously more favorable than others, and there's some you would definitely avoid. But all governments, and this is only going to increase, are looking at gold as a potential source of revenue because gold is going to go up. These companies are going to make a lot more money and produce a lot more, so it's going to be more attractive to them. The government can change the rules at any time. We all know that. They do it to us all the time with our taxes. So it is smart that these companies are diversifying geographically. And some companies are better at doing it than others, but Agnico Eagle stock that we like is one that is doing an exemplary example of doing that.
Let's talk about the current market. We've seen gold stay above 1,000 for the longest time that I can ever remember. You have a lot of people on the technical side of the market. A lot of gold writers, newsletter writers have suddenly become bearish, or they're somewhat skeptical of this move. Any comments on that? Are they being overly cautious, or due to this run-up? I mean, we are in that favorable seasonality time where gold tends to do very well around this time of the year, leading into early spring. What's your view of the gold market?
Well, that's true. This is the seasonal time for gold, so it's not terribly surprising that it's going up. It shouldn't be a surprise to anyone who studies the gold market. This is the time of year for it. And I could easily believe that it's going to continue to do so until the end of the year. Where we stand right now, we've had the highest nominal close in history here at 1,064, I believe. But when you adjust for inflation, that's only, half what the gold price could be. There's plenty of upside left. So a $2,000 gold price, is what you adjust when you get inflation. And when you throw in 10% or higher inflation, which Casey Research believes that we'll see at some point, gold's going to have to go much higher. In the short term, anything, of course, can happen. It's been a fun ride. I could easily believe that it could correct here. I could easily see it going to 1,200. I could easily see it going back down to 900. So there is a little froth in the market. I would agree with that.